David, that's got to be a Goldilocks situation for investors, right? Because you've got the economy being supported and you're still going to get rate cuts.
That's the second time I've heard that today. And Jeff was spot on with his analysis. Look, I'm the stock guy. And the first place I went this morning when I saw that number was to bonds. And yields were up across the entire curve. So the idea of a 50 basis point cut in November, that's likely off the table. What struck me was that even the terminal rate, where the Fed is going to, even that was up at 3%. But Jeff makes a great point. I think the Fed has to continue to cut. Maybe the pace is going to change, but real rates are still very restrictive. And frankly, over the last half century, the Fed has gotten that wrong. I don't think they want to make that mistake again.
What does this mean for your overall view? Do you remain constructive on equities? Is it just kind of a green means go signal if you want to load up on equities?
I think investors will watch the path of what the Fed is going to do. But, the investors kind of been in a holding pattern, a lot on their plate, geopolitical tensions on two sides of the planet. Oil prices have been rising. And frankly, right here in the United States, U.S. markets have probably pushed the multiple expansion concept about as far as it can go. The spread in valuation between the United States and the MSCI is about as wide as I've seen in the last decade. The good news is that estimates are rising, and we're going to get an answer to that report card, starting next week, and that's really the major catalyst in the next couple of weeks. Over the next month, we're going to be hearing earnings from a lot of our favorite companies, and that's going to really set the stage for what the rest of the year looks like.